How to go fast. One, you have to buy right. You got to buy in affordable markets. Even in your affordable market, I would say Philly's an affordable city, Pittsburgh's an affordable city, Baltimore, of course, Cleveland, of course, Columbus, of course. Even there within affordable pockets, because every city, even an affordable city, has an A class, B class, and C class. So you still have to dig in. You have to buy in the right markets. You have to make smart buys. You really do make money on the purchase in this game because it's the only thing you can control. The cost of construction is the cost of construction. It takes how long it takes. You need to really buy at the bottom, I would say, at the lowest price that you can get. So you have to know how to do your analysis to purchase right, get into the right areas, and get into affordable markets. If you're in priced out markets, California, New York, Colorado, you have to invest out of state. That's going to be your barrier to going fast. If you try to invest in a more expensive market, it's not that you can't make spreads. It's kind of more risk per dollar. If you look at the debt, like if I had to go in 150K of debt to make $1,000 a month, or 500K of debt to make $1,000 a month, I'd rather go in less debt to make the money. So you have to look at these affordable markets. Even if a more expensive market could cash flow, is it worth it for the higher debt carry? Because there's a real risk associated with the cash flow. And the risk is, what if that check doesn't come in? How much is the carry? So you have to be in an affordable market naturally to have the confidence to go fast and have the metrics to go fast. Because you won't scale into what doesn't look profitable or appear stable. You want to focus on cities with strong rent to price ratios for that reason. That's one thing that you like about Baltimore, is the rents are about as high as Philly, but it's a cheaper market. So that means it has a strong rent to price ratio. So you start looking at those markets, strong rent to price ratio and low property tax ratio, respective property tax, because some places have a very high property tax by percentage, but their property values are low. So the actual monthly payment is very low. So getting into like the relative property tax, that's an important aspect of cash flow, because your cash flow is rent coming in and usually mortgage, insurance, and taxes going out, management, maintenance, certain aspects. So strong rent to price ratio is going to tell you what you need to know if this is a market worth evaluating.